Welcome back. We're basically family now with all the time we've been spending together lately. We are on chapter 3, which is all about property taxation and assessment and has a little bit of math. Let's quickly jump into this one, but you know the drill. Hit the subscribe button down below. It's a free way for you to support this channel, as well as by clicking that thumbs up button down below. I'd really appreciate it. And again, the YouTube algorithms love that kind of thing. The classes are also 10% off for new signups. Link is down in the description. Now let's go. All right, the North Carolina Machinery Act. So the state laws actually set the process of how to set the taxes, while the county is responsible for actually carrying out the details. This is also called the Revenue Act. Here in North Carolina, your property taxes are based on your assessed value, which is 100% determined on your market value of your property. If you go to realtor.com or Zillow right now and you find a house that's listed for $300,000, and all the houses in that area are around $300,000, it's fair to say that the market value is probably around $300,000. But when you scroll down on the listing, you'll notice that the last tax assessed value was $250,000. So you might be asking, how is a tax assessed value 100% of the market value? Let me explain. For the North Carolina Machinery Act, that appraisal is done every 8 years. So at some point in the last 8 years, that $300,000 house was $250,000, just like the tax assessed value says now. It's not a fresh, up-to-date number at all times. All right, so more on the North Carolina Machinery Act. So the appraisal is done every 8 years, but the rates can change every single year. So if your current tax rate is 2%, it could be 2.1% the next year. And lastly, there can be a horizontal rate adjustment every 4 years, which means every property has a rate bump, not just one person. So again, real property in North Carolina can have the rates change every single year. Across the board, horizontal adjustments can only be made every 4 years. And now this next point gets back to some of the previous chapters where we covered liens. Real estate taxes are always the #1 lien set on your property, unless there's a foreclosure. This means it's the highest priority. The taxes are levied ad valorem, another one of those old words they love to use here, which means according to value. So they're not going to tax you some crazy out of this world amount, no matter what it seems like as the payer of taxes. Sometimes it just seems absurd. There's a reason for it. They can't just charge you willy-nilly. Special assessments are another type of lien we'll cover right now. And first, remember the other 2 types of liens we've discussed previously? So right now we've talked about tax liens and we're about to talk about special assessments, but there's 2 more. Yep, so it's mechanics lien and foreclosures. So special assessments are placed on specific properties and usually by an HOA or someone, and they're things that get paved, like maybe your sidewalk, or it could be work on a sewer line, things like that you'll end up having to pay for as a homeowner. All right, for real property taxes. So this is where we start getting into a little bit of the math, but I'm gonna build a small foundation for us to build that math on top of. For property taxes, the lien hits you on January 1st of every year, and it hits you in advance of when the taxes are due. And this lien, the taxes, become due on September 1st through January 1st of the same year. They become delinquent on January 5th of the next year, and you'll have to pay a late fee. So for clarification, here's a little timeline. Taxes on your property come in advance on January 1st. The tax bill is sent to you in July for review. They are due on September 1st through January 1st of the same year. And on January 5th, they are late. And now for the math part. It's not actually the end of the world though. Please, please, please think about all these things logically. If you get stuck on the test, just take a step back and really think through these situations. The numbers and the stress of this test will mess with your mind. A good example of this is when we're calculating taxes here in a little bit. They're gonna ask you the difference between the mill rate and the tax rate per $100. And it's easy to mix this up. But when you work through this problem and you get one answer that's $200 and you get another answer that's $2,000, and you're talking about taxes for a $500,000 property, it's very unlikely in real life to have $200 worth of taxes on a $500,000 property. $2,000 is a little bit more realistic. So if you're stuck between 2 answers like that, pick the one that just seems real life, that seems logical. If you're only paying $200 on $500,000 house, Give me the name of your accountant, please. Tax rates are expressed as so much per $100 of value or so much per $1,000 worth of value. So I'm going to put up an example here. So they'll say $1.50 per $100 of value, or they'll say $15 per $1,000 of value. If they say $100 of value, you move that decimal point 2 places to the left. If they say $1,000 worth of value or mill rate, you move that decimal point 3 places to the left. You'll see that no matter what, you are at 0.015. And I'm telling you, me talking about it isn't going to necessarily help you. If you do one problem, or if you do 2 problems, one in each scenario, you're gonna get it. This is actually extremely simple. You just gotta try it one time, I'm telling you. Regular rate, whatever, per 100 versus mill rate. Per $100, per $1,000. Simple stuff. So a lot of the courses will teach you the circle method or the circle device, which I'm not the biggest fan of because I'm somewhat decent at math, but it's actually a great way for someone to teach someone who is not that great at math. It's easier to follow along, especially visually. So I'm going to continue to use that just so I stay in track with what other people are teaching you and so I could display it visually for you. On top of the circle, you have the tax bill. On the left, you have the assessed value, and on the right, you have the tax rate. To find one of the missing quadrants, you just simply do the math of the other 2 quadrants. If the tax bill is missing, you just multiply the assessed value by the tax rate. If the tax rate is missing, you just divide the assessed value by the tax bill, and so on. And let's jump to an example, because there's no better way to show this to you other than that. So the question is, what is the annual tax bill for a property assessed at $500,000 if the tax rate is $1.50 per $100 of value? Okay, so remember that tax rate rule. We have $1.50 per $100 of value. So we already know right away, move that decimal point 2 places to the left, which leaves us at 0.015. Now if we look at our little circle chart, we simply multiply the $500,000 by the 0.015. And boom, we get a $3,000 tax bill. And guys, let's stop here for a second. Think about this logically. A $3,000 tax bill for a $500,000 house seems very realistic. And if we had gotten $300 as an answer, and $300 was an answer on the test, and we didn't stop for a second to think about it logically, you would have selected $300 as an answer on the test, when in fact it's $3,000, which again, you can sit back and think about it. $300 on a $500,000 house is insane. Again, let me know who your accountant is, if that's what you're paying. And let's do another. What is the annual tax liability on a property that is assessed at $120,000 if the tax rate is $1.60 per $100 of assessed value? $100 of assessed value. Pause the video if you need to. So again, this is per $100 worth of value. So we're going to take that $1.60, move the decimal places 2 places to the left to get 0.016 tax rate. This is similar to the one that we just did. We simply just multiply the $120,000 by the 0.016 tax rate to get a $1,920 tax bill. Again, this amount seems realistic, so let's move on. Now we're going to try a different kind. If the property has a tax rate of 8.25 mils with a tax bill of $1,780, what is the assessed value of the property? Again, pause if you need to. So now this one is 8.25 mils, which means per 1,000. So we will slide the decimal point 3 places to the left this time, which gets us 0.00825. This time, according to the circle, the tax bill is on top. So we simply divide that by the 0.00825, which gives us an assessed value of $215,757.58. Cool. Next one, let's get the tax rate. What is the approximate tax rate per $100 of value on a property that is assessed at $110,000 if the annual tax liability is $2,090? This is way easier than the other 3 that we already did. Take the $2,090 tax bill and divide it by the $110,000 assessed value, and this will give you a tax rate of 1.9%. A few things to note here is that if they are talking about a parcel of land initially, but then say somebody added a new construction house to the property, you must add the value of the land and the value of the new construction property to get the total property amount. Taxes are based on the total value. They'll ask a question like, there's a $30,000 lot and a owner builds a $80,000 house on the property. What is the total assessed value? Take the 80 and the 30, add it together to get a $110,000 property, and then find the rate or the bill after that. So another note, if they split up the tax rates by county and by city, and the property we are talking about is both located in the city and the county, then you'll need to add those tax rates together. So they could say the tax rate of the county is 1% and the tax rate in the city is 2%. So the total tax rate is going to be 3%. However, there will be trick questions where it'll specifically say that there is a tax rate in one county and a tax rate in the city, but it'll say the property is only located in the county. It's not located in the city. That means you don't use the city tax rate. You only use the tax rate of the county. And lastly, for the section on the math, you have tax prorations. You'll need to remember a few things to do these problems correctly. In real estate, we always use 360-day years, not 365-day years. And this is actually made to make it easier on you. Go figure, right? When you talk about how many days are in a month, there are 30 days in every single month when we're referring to real estate. There's no longer 28 days in February and 31 days here and so on. Every month is counted as 30 days, which gives you that total of 360 days for the entire year. For tax prorations, we'll need to determine who's paying their fair share of taxes on the day of closing and how much they'll be paying. Another note is the seller actually pays the day of closing taxes. So if we close on May 28th, they're responsible for the May 28th taxes. The buyer's taxes don't start until May 29th. There are 3 ways to classify the taxes here. For unpaid taxes, you debit the seller and credit the buyer. In simple terms, if a seller of a home has not paid any taxes on their property, it's not the buyer's responsibility to cover those previously used taxes or previously owed taxes. So remember, property taxes are placed as a lien on your property on January 1st. If a home is sold on February 1st and the seller hasn't paid that entire January tax bill yet, then at closing, the month of January taxes will be debited from the seller, taken from the seller, and credited to the buyer or given to the buyer. Because again, it's not the buyer's responsibility to cover those January taxes when the buyer didn't live in the property in January. So again, for unpaid taxes, you take from the seller and give to the buyer. For already paid taxes, you actually credit the seller and then debit the buyer. This is the opposite scenario of the previous one. If a seller has already paid their taxes for the entire year, the buyer isn't just going to get off scot-free of paying taxes for the rest of the year. Again, now it's not the seller's responsibility to cover the taxes that they're not going to be using while the buyer is living in the property for the rest of the year. The buyer will have to credit the seller those taxes. For instance, if a property is sold in November and the seller has already paid the property taxes in December, the property tax will then be debited from the buyer and given back to the seller. It's just fair. The last way to classify taxes is collected and paid, or double debit. This is done towards the end of the year when you have the seller pay their fair share of their taxes, and then you have the buyer paying the rest of the year taxes, and it goes straight to the tax assessor, tax office. You'll see one of each of these scenarios in some of these problems we have coming up. All right, so let's get to some examples here. The yearly property taxes are $2,010. The closing date is March 18th, and the taxes have not been paid. What is the debit and credit at closing? First thing we'll need to do on all these problems is determine how much are taxes per day. You simply take the $2,010 and divide by 360 days, which gives us $5.58 per day in taxes. So now we multiply that by the amount of days that have passed. So you have January, which is 30 days, February, 30 days, and then March, you go to the 18th. So that's 30, 60 plus 18 is 78 days that have passed. You multiply that by the $5.58. So that gives you a total of $435.24, which was how much the taxes were while the seller was holding onto that property. The problem said that the seller has not paid any taxes on this place yet, it's not up to the buyer to now pay those taxes that have already passed or been owed. The buyer isn't going to cover them, so we must debit the seller or take from the seller that tax amount and then credit it back to the buyer. Because eventually, towards the end of the year, the buyer is going to have to pay for all those taxes and give it to Uncle Sam. Great, now another. The yearly property taxes are $1,880. The closing date is November 15th. The taxes have already been paid by the seller. What is the credit or debit at closing? So again, take the $1,880, the tax amount, and divide it by 360 days, which gives you the total of $5.22 per day in taxes. The amount of days that have gone by are from January 1st to November 15th, which is 315 days. So we multiply the 315 days by the $5.22, giving you a total of $1,644.30. But this time the seller has already paid all the taxes for the whole year. They have already paid the entire $1,880 owed. But they only owned the house from January 1st to November 18th, not the entire year. So now the buyer isn't going to get off scot-free from paying December and the rest of those November taxes. They're going to need to be debited and pay up. Therefore, we take the total $1,880 taxes for the entire year and subtract the amount that the seller had lived in that house, which was the $1,644.30. And that'll leave the buyer with $235.70 to be debited from the buyer and credited back to the seller. The other way to do this and to double check your work is to take that $5.22 amount and take that and multiply it by the amount of days that the buyer is going to own it, which is from November 16th through December 30th. And when you multiply those two together, the amount of days, that's 45 days multiplied by $5.22, which gives us the $235. All right, so the last example here is unique. The yearly property taxes are $1,440. The closing date is December 15th. Taxes are to be paid directly to the tax collector from the closing. What is the entry for taxes? All right, so take your daily rate of $1,440 and divide it by 360 days, which gives us $4 per day. Then that's 345 days for the seller and only 15 days for the buyer. So multiply that $4 per day by the 345 days over here for the seller, and that's what will be debited from the seller and given to the tax collector. Then you have the $4 per day multiplied by the 15 days that the buyer owns the property. You debit that from the buyer and give it to the tax collector. This is why we call it a double debit. So I think that's enough for this lesson. I tried to cover a variety of examples here. I'm fairly confident in my math skills, but I feel like it's much easier to teach in person, or maybe I should start using a whiteboard here. What I'll say here is that if you want me to do a purely math video where I just dive deeper and deeper into some of these problems, I can definitely do that. And maybe I'll use a whiteboard or some better way to visualize some of these examples. I don't really know what to expect from these videos, but if I get, let's say, 100 likes on this video, I'll be sure to put out a math video within a week from that goal. Otherwise, let me know what questions you have down in the comments below. I'm usually pretty good at responding back to those, so hit me up. Thank you so much for watching this video on the North Carolina Real Estate Exam Prep, Chapter 3, Property Taxation and Assessments. Please subscribe so you can follow along. Tell your classmates and your buddies about this. Give it a thumbs up. I'll see you on the next one for Chapter 4. It's a little more entertaining, and peace.